Hi, welcome to your monthly investor update. I'm Jennifer Montgomery. I'm the Financial Planning and Analysis Executive here at Nutmeg. If you watched last month's update, you'll know that we're currently following the government's guidance on social distancing and working remotely. So instead of filming the investor update at our headquarters, we're doing it here on Zoom. But of course, we'll still be covering all the usual topics to make sure you're kept informed. Today I'm joined by Brad Holland, our Director of Investment Strategy. Hi Brad.
Hi Jennifer.
So the past month seems to have brought some good news for investors with a little bit of a rally in global stock markets. Can you tell us more about that, please?
Yes, the sharpness of the rally since March 23rd has come as just as much a surprise as the speed of the decline in February, March. World equities rose by 11% in April. The US up 13%, and US NASDAQ index of technology companies up over 15%. From its lowest point in March, the US S&P 500 has risen 30% to the end of April. Pretty eye-watering stuff. Not so in the UK though. Its main index only rose just under 4% in April, although the mid-sized UK company index did better at just around 9%. The key reason for the bounce in that is that government's economic policy has swung in a big way. The US Central Bank, the Federal Reserve, was the first to come out and say that it would do whatever it takes to stabilize the financial system. That was back in March 23rd. In April, the Fed said it will be buying below investment grade bonds as well as government and investment grade bonds. In April also, the Bank of Japan began using that same whatever it takes language. Other central banks have also highly accommodative policies, so much so that even though equities have rebounded, government bonds also performed well on the month. Normally, these markets move in different directions. But it's really the fiscal policies clarified further in April that are truly eye-popping. Japan has so far announced 22% of GDP stimulus, Germany 20%, France 12%, the US 9%. The UK, 6% of GDP. Now, these numbers are not set in stone and could be higher or lower in the end. But the important point is the intent of policy. Now, it's worth noting too that the vast bulk of Nutmeg customers did not alter their portfolios during the drawdown in February, March. And so they benefited from the rebound in March, April. Good investor behavior, taking a long-term perspective and accepting that the road will get bumpy along the way.
Now, about oil prices, we've seen some historic moves recently, including briefly a negative oil price in the US. How did that happen, and what does that mean for our investors?
Yes, it seems there was a technical hitch at the April expiry of oil futures contracts, all very unusual. It seems there were some large purchases of oil contracts by investors who either didn't understand they needed to take physical delivery of the oil or decided at the last moment they didn't want to. And that helps explain the negative oil prices as the April futures expired, some owners paying to have the barrels of oil taken off their hands. Of course, the oil industry is not without its fundamental problems, not least of which that the US is running out of storage capacity for the oil it produces. But the events of April were wholly unrelated to the events back in early March when COVID-19 shutdowns killed off oil demand at the same time that Russia and Saudi Arabia started an oil price war. That's worth noting, unlike in that early March episode, the equity market was very stable throughout this month's oil price volatility. Well, let's face it, more than stable actually. World equities were up 11% on the month.
And apart from COVID-19 and the oil shock, are there any other big economic stories that we should know about?
Yes, there have been some big economic news, some positive, some unbelievably negative. Let's start with the good news. Chinese data has begun to improve as it reopens its economy. It's not an instant rebound. Consumers will take some time to get back to normal spending patterns. But business survey data has snapped back as the pessimism during the shutdown has subsided. Now, on the negative side, the US labor market printed over 20 million unemployment claims during April. That's 12% of the US labor market. Now, obviously, a lot of this is temporary, but the numbers put in stark contrast the shock that is still underway in the first half of 2020. The reality is that we can't get a clear picture from the economic data while we are living through the shock. And that reality is ever present. We are now in the middle of first quarter earnings season. Not only are companies reporting a slump in sales and profits, which was expected, but many of them are refusing to give the usual guidance on the outlook for their businesses. But don't forget, the government support for businesses and employees that I've already mentioned is expressly designed to help the economy through the hopefully temporary shock.
So how did the Nutmeg fully managed portfolios perform during the month?
Well, the high-risk portfolios rose by 7.5%, mid-risk portfolios about 6%, and the lower-risk portfolios rose between 2 and 5%.
And given everything that's happened lately, have you made any changes to Nutmeg's fully managed portfolios?
Yes, we have used some of the cash buffer that we built up during the February-March equity decline. And we've also moved out of low volatility equities as we thought the worst of the panic is over. We've also moved underweight emerging market bonds because we think there might be some structural issues ahead for heavily indebted emerging markets. Now, the cash raised from all these sales was placed in Europe to reduce our underweight there, as well as in good, sustainable companies via World and US SRI, which is Sustainable and Responsible Investment.
So this month's customer question came to us during one of our recent webcasts. Tim asks, what's your best current thinking of when we may be financially back on track with our investments post-COVID-19?
Well, if back on track means when will we be back to early 2020 portfolio levels, that may take some time yet. The US stock market in particular has put in a good recovery, but we need to be realistic. A lot has changed and the market needs to get a clearer picture. Possibly greater clarity will come in the second half of the 2020 on the economics. Now, it's obviously important that we don't have a serious new second wave of COVID-19 infection this year, providing time for antiviral drugs to become available. There's still plenty to be watchful for too. The US election in November, the tone of the relationship between China and the rest of the world, not least the US. Certainly there has been a better feel in markets in April, but we remain cautious, maintaining a small equity underweight in our customers' fully managed portfolios. But we maintain a heavy overweight in the US and in technology shares.
Thank you for that update, Brad.
Thanks, Jennifer.
And thank you for joining us. We know this is a difficult time and understand that lots of our customers have questions. Please feel free to contact us via email, social, or in the comment sections below, and we'll do our best to answer your queries. In the meantime, our best wishes to you, your families, friends, and colleagues. We look forward to seeing you next month. Thank you.